Passive Pockets is presented by Equity Trust.
Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm Chris Lopez, here with my co-hosts Jim Pfeiffer and Paul Shannon. With October wrapping up, it's time for our Passive Pockets Pulse Check. Each month, we highlight what moves we're making in our own personal portfolios. We talk about what we're seeing in the market. We share a tool tip from PassivePockets.com. And then this month, we're going to do a live deal review and really dig into the waterfall GP-LP alignment and talk about how much fees is too much fees. All right, so this is a great discussion. Let's jump into it. Jim, Paul, I'm excited to do our third monthly roundup here. Good morning, guys.
Good morning, gents.
Good morning. Even though you guys are making fun of my hat, I am ready to go.
Well, I mean, it's interesting how we all got three different colors, so we're working on that. But maybe we'll take a vote in the comments who's got the better hat, right?
There you go. I like that.
Maybe the LPs will give you some love, Jim.
I hope so.
So Jim needs an ego boost. Vote for his hat, everyone. All right, on to some serious topics. Want to talk about kind of what we're doing with our own, money, our own portfolio, some updates on investments, some new things we're looking at, or investments that we are making. Jim, start off with you, man. What's new with your portfolio?
Shockingly, with my limited capital, I said yes to 3 deals this month and only invested in 2 of them. The first one is the Praxis Healthcare Fund, which we've talked about on the podcast. We did a deal review live at BPCon. I'm going against one of my normal things, which is I'm not going to be your guinea pig. And as we talked about at BPCon, there's a lot of reasons why Brian Burke, I don't feel like a guinea pig on this one as much because he is going to a new asset class. He hired someone who's been in the industry for 20 years that he's also known for 20 plus years. So the thing that was really tripping me up on that one was the minimum. It's $100,000. And I really didn't want to test someone out with $100,000. Brian, although a great friend of Passive Pockets, will not bend on minimums. So we did it in a group. I have a Tribe Vest Tribe. We have a group, so we kind of all pitched in some cash and got into that one. So that's deal number 1. Deal number 2 is another one that I found through Passive Pockets, and we did a deal review on this one as well as a deep dive deal review, and that's the Green Coffee Company. Again, the $100,000 minimum on an asset class that I'm not super comfortable with was the thing that was really slowing me down. So as I often do, and others should as well, I just reached out to the guys at Green Coffee and said, I really want in your deal, but I can't get there at $100,000. So they reduced the minimum, and they did that for the entire Passive Pockets community, actually, and are still giving us the share discount for that. So I was pretty thankful on that. So I did invest in that. Those are 2 deals that are, a little bit different from the normal real estate deals that I do, but I was pretty excited about those 2. And then the third is where I kind of have a little bit of FOMO, but I'm also kind of proud of myself for invoking the Shirky rule. And that is a multifamily deal that actually InvestWise Collective, Paul Shannon, is putting out. I was ready to invest in that. I looked at the deal. I really liked it. And then my limited capital kind of put me in check. And then I also thought, okay, I know Paul really well. I completely trust Paul and InvestWise. But one of the rules, the Shirky rule, is you don't invest with the same operator twice in 1 year if it's new to you. And I invested in Paul's earlier multifamily deal. And so for that reason, and the fact that I was running out of capital because I invested in those other 2 deals, I did not invest in this deal with Paul, but it was purely because I'm trying to follow the investment rules that I put in place a little bit better, although I didn't do that with Praxis. So I'm kind of on both sides of the fence there, I guess. So that's what I've been doing.
Well, this is the first time I'm hearing that, Jim, and I didn't know that. We just rolled this deal out. We haven't even done the webinar yet, so I guess I have some time to work on you, but I think that you're a man of principle, so you should stick to your guns and sit this one out for sure.
Well, I'm sticking to my guns on this one, but I'm not on the guinea pig rule with Brian Burke. So it also has a lot to do with capital, right? You have to allocate capital when you have it, and just because Paul Shannon has a great deal out with InvestWise, and that's one where I normally jump on because I do, it's part relationship. I like the operator. I'm also limited on capital, and I do want to see how this first multifamily deal does. It's going great so far, but I'd like to just practice what I preach a little bit, which is hard because I do chase the shiny object, and I like to get into multifamily deals. So that's where I am.
I want to highlight a few things though here that you've done very well. Hey, you have your rules. And I mean, rules are ever evolving, but also you're investing with an investing club, which I think some people are familiar with, a lot are not. But I think a couple podcasts ago, Paul and I interviewed Mauricio, and we touched on them briefly, but we talked a lot about them after we hit end on the podcast. He's going to update, he's like an ebook, he's going to update his ebook on investing clubs. And he's going to come back for round 2 to really do a deep dive on investing clubs, because they are a great way for like, hey, people go out there, pool capital and invest in multiple deals, but have less capital in each deal. And the second thing you did, Jim, you asked for a lower minimum, which it never hurts to ask, because what's the worst they say? They either say no and whatever, or they say yes, and now you're putting in 25 or 50 versus $100,000.
Yeah, and the thing is, as a community, we should all be asking that. And then if they say yes, then say, hey, can you give those terms to my entire community, and then share that. And that's, I shared that in the forum that Green Coffee agreed to go down to $50,000, and hopefully some other people were able to get in on that, because it is, especially for an asset class like that, $100,000 is a big minimum. So I was thankful that they agreed to lower it.
So, Paul, apparently you have a new multifamily deal you're working on, huh?
I do, yeah. We have a new offering in Indiana. It's a 100-unit, 1990s build. It's a cash flow play. It's nothing, as far as shiny objects go, it's certainly not that. It's a boring, down-the-fairway type investment for a cash flow investor. We're going to average 9% average cash on cash at pro forma over a 7-year hold period, and it's a 15 IRR. It's a pretty simple business plan. We've got a great joint venture partnership with a group that I've had a relationship with for a couple of years, so we're actually hosting a webinar next week on that offering, and looking to close sometime late in the year towards Christmas. So very excited about that one. From an active perspective, also working on a 22-unit apartment that we acquired via joint venture partnership that I mentioned in the last time we had an episode like this. So we just finished the exterior. It was a heavy lift, a lot of CapEx spend on non-revenue generating items, which is never fun. But now the curb appeal is really solid, and we started to work on the interiors now. So we're going to get those units filled that have been sitting vacant for a while and really changing the community. So excited about that, but that's been quite a bit of work and eating up quite a bit of bandwidth. From an LP perspective, just being passive, have a win. Invested with Threefold Real Estate. That's Lee Yoder. A couple of years ago, he bought a 64-unit 2-pack. So it was, I think it was 48 and 16.
So 2 properties?
2 properties, yeah. He's got an offer right now on the 16-unit, and they're looking to close here fairly shortly. And it's a nice solid profit on what they acquired it at acquisition. So that's going to give us as investors, as limited partners, about 25 to 30% of our initial capital invested back. He's going to hold back some of the profits and keep those as additional reserves for the 48 unit. And the business plan is on track for that as well. So, he acquired that during a time where there's some challenges in the marketplace. And as a good manager, as I found him to be, he's really worked through some of those challenges and come up with good outcomes for investors. So pleased with that. And considering a couple other investments, there's a fund right now that I think is kind of attractive that's acquiring a lot of different multifamily, or pieces of a lot of different multifamily properties around the country. I'm not going to mention names at this point because I haven't invested in it, but looking at it, and I just think it would offer some nice diversification. And all he's doing is charging a 1% equity under management fee as the fund manager. And he's really trying to go for, scale and have different types of assets, cash flow, appreciation, different, asset profiles in different markets. So it just give you little pieces of a larger portfolio across the country, kind of like similar to how Jim's investing in a tribe. This would be individual investing, but, well diversified assets all across the country, and giving you kind of, small slices of each one. And then from what I'm told, I think AAA Self-Storage, who I mentioned I invested with, is still waiting to deploy that capital. They haven't called the capital for their Growth Fund 2, which will be a self-storage development offering. I think they're going to be calling capital pretty soon. So I'm anxious to get that money out of my account sitting idle and going to work for me and start making some returns here, which I won't see for a couple of years because it's a development deal, but would just like to get it out so I know that it's actually utilized and allocated. So that's what I got going on.
That's the kind of capital call that you don't mind having, right? Just so everyone understands, capital call, sometimes they're planned, meaning, Paul invested in this deal with AAA. They haven't started development. They haven't needed to spend money yet, so not going to ask Paul for all of the money until they're ready to spend all of the money. And that's the same thing I'm going with the Praxis deal that I'm in. They called 65% of the capital, so I'll wire that to them this week, and then we'll go from there. And then, Chris, I neglected to mention one more update. It's not a deal I invested in, but before we swing it to you, I just wanted to to update people on the one of the Wolf investment deals I'm in. This is the one I think last time we were talking, mom and dad were fighting, right? There were co-GPs, and both of them claimed that they were running the deal, and both of them claimed that the other guy is stealing it from them, and both of them claim kind of that the other person is a crook. I don't know who, whether to side with mom or dad. And now they came up with a new idea. One of the GPs, not Wolf, but the other guy, Augustino, he is now putting it up for a vote to change, not to remove a manager, because I think there's some things in the operating agreement that would preclude that, but to change the managing entity that runs the deal, the LLC, that is the manager of the deal. And so he put out a video and is sending out a DocuSign for everyone to vote on. And the one thing that I wasn't clear on, because there was no information about what this new entity was, this new LLC that was going to manage the deal. And that manager should get then the fees and all the things that are entitled to the manager from the operating agreement. And so I asked the question, hey, whose is this? How does that all work? And he definitely gave the answer, right? There's nothing shady about it, but I think that the thing I was questioning, or not, I guess disappointed isn't the right word, is he didn't come out and say, hey, this is my LLC that I own 100%. I am going to be the sole manager of this deal if the vote goes through. And then after I had that conversation with him, he did go out and send an email to the entire investor base and say, hey, here's how that LLC works. And so I think, again, just an illustration, you can't be afraid to ask these questions, right? He's not changing the operating agreement other than he's putting in a new manager. Well, if we don't know anything about the manager, we need to ask all these questions. And so I think he'll be a good steward of this, and all we're trying to do is sell it. So I don't really care who the operator is, as long as the deal gets sold and the money goes where it is supposed to go. So I just wanted to give a little bit of an update on that, because it is definitely a unique situation.
So a couple updates on my end, and I just kind of went through and did all my Q3 here type updates for my own internal stuff. And so I've got some exciting updates and some updates that I'm not excited about as well. Some of the good ones are, one of the debt funds I invest in, they paid out like 2.2% last month. So that was the highest they've paid out yet. I mean, it was like a tenth or 2/10 higher than what they've been paying out. So, I mean, it's still within range, but I obviously love seeing that is, hey, they perform, they're paying out. And this kind of brings me to a strategic decision. And I want to talk more about this with you guys next month. But I wrote my investment thesis kind of from the active to passive cohort I ran earlier this year. And personally, I'm shifting a lot of my equity, my real estate equity, over to debt funds. I'm probably like 85 equity, 15% debt right now. I mean, I want to get to like a 50-50. Now that'll take a couple years to swing that around. But I bring it up because I got one of the multifamily funds I'm heavily invested in. They're churning a few properties in Q3 and Q4. And it was really exciting because they bought a lot of these properties in 2024. So, hey, a good time. Hey, not the best time, as I'm realizing now in the market, right? Hey, properties are still going down, but they bought them so low they can still turn around, sell them. I think the Fed interest rate cuts have, helped that a little bit. But they bought a property for 1.8. They're turning around. They got it for LOI for about 2.5. And they've done some value add in there. So it'll be, nice recycling of it. There's 2 or 3 properties we're selling. So I'll probably get, a good chunk of money back. I'm debating, hey, do I invest in more multifamily right now? Because I love depreciation. I love the asset class. But then my strategic goal is to move more towards like cash flow and debt. And of course, after receiving some high payouts from this other debt fund, I'm debating which way I'll go. Now, hey, this will take a couple months for the multifamily stuff to obviously sell and pay out, but it's good stuff. So I'm looking forward to discussing this more with you guys next month. A deal I'm not happy with, and I thought this deal was going great until about 3 weeks ago. All of a sudden, we got this just like letter with like, oh, here's like 5 things going wrong with it. It's a 50-some unit single family development deal in North Denver. And so I liked it because they're building median price point. Now invested, I think, 12 or 18 months ago, or 12 months ago, the thesis, say by the time they deliver, the market should hopefully be recovering. I don't think I timed that very well as I'm looking back now. But what I don't like about it is they found some buried oil drums. So now it's having to cause a whole lot of environmental issues. And here's where it gets really stinky is the reason I invest in the deal is because they're right on a lake. And we don't have many lakes in Colorado. And so like if you can have a house, next to or right on the lake, it's super premium. Double-edged sword now that they found buried oil drums on there, because now they're like, hey, we're 30 feet from here. So you have to be very careful that they have to mitigate the risk so it doesn't leak into this reservoir, which is drinking water. Now, this came out, the seller did not disclose it, and the seller talked about it with the broker, but did not disclose it in the seller, disclosure sheet. And he admitted it. They're in mediation, but looks like they're going to go to court. So, just a messy deal. Luckily, the lender's on board. They flew out to do a site visit. They'll help fund and extend some things. But I think it kind of shows just some, poor sponsor DD. And one of the other things that really irritates me is like, oh, the construction manager, either they hired or they're sub-hired, they think had about $500,000 in fraudulent invoices. How that happens, I have no freaking clue. But that kind of goes down to, hey, just poor communication. Everything is going great. Like last month, things were going great. And all of a sudden, it's like, oh, this does all not happen for the last 4 weeks. Like there was very little transparency, and I'm just not happy with the sponsor. So I'll see where that project goes, but it may turn out well, may not turn out well.
Do you know, Chris, if the lender required an environmental study? I would think that oil drum would have showed up if so.
I think so. I don't know. This is also part of the other thing. When we bought the property, it was supposed to be a 65, 75% LTC. They ended up going to like 82% LTC without me or knowing until like 6 months later after the deal was already invested. So again, poor transparency, poor communication. This is a pretty big site. So I imagine the lender did require it, but that is me guessing. And that's pretty normal for like Colorado property sales. But I don't know if they just missed in that one spot, or based on how the sponsor is doing, maybe they just did, a poor job or didn't do it altogether. So yeah, I don't know. Hey, right. That's the passive nature. It's great when it's great. When it's not, you're like, what the heck, guys? But yeah, overall, I'm really happy where debt is at in terms of like paying out. And then I'm happy to see multifamily. It sounds like you guys are in the same boat. Like multifamily seems to be starting to trade a little bit as well, which is really, really nice to see.
Yeah, definitely some momentum with multifamily. I feel like things are stabilizing, and I've said this before, not all green lights, but if you wait for all the lights to turn green, you're probably too late. So there's some yellow lights, some caution flags out there, but I think the fundamentals are improving. We're still going to have a couple years of a little bit of softness as far as rent growth, and there's still some units to be absorbed from so many coming online during the boom and the development with cheap money in 2021, 22, and these deliveries that have come to market. But I think if you can get through the next couple of years, multifamily is going to be really strong. I'm curious, Chris, about your debt and your allocation strategy. You said you're about 85-15 equity to debt. Where is the kind of sweet spot for you of where you want to be in a couple of years? And are you considering, taxes? Because if it's outside of a qualified account, these debt funds are going to be taxed. Your income is going to be taxed at ordinary income tax rates. Is that playing into your strategy at all?
It's a little bit. Right now, 50-50 is kind of what I wrote where I want to, target to allocate. And I think that'll take me like 2 to 4 years to kind of shift everything. And, we all know real estate rebalancing is not happening quick like it does in our stock accounts. So right now I'm at 50-50. I am funding a lot into like my solo 401k or my self-directed 401k. Like I am prioritizing that for like new capital. And I like debt funds and retirement accounts, let them compound. So I'm putting a lot into there. And I am debating right now about the tax consequences for, non-retirement money. Because a lot of times for the last 4 or 5 years, I've always gotten an extremely healthy tax refund from just, all the bonus depreciation and, and all that good stuff. And I'm debating, hey, do I just take a higher cash flow, but maybe bite it on taxes? That is like TBD at the moment, but I will probably find some happy medium, but I don't have like the crystal ball figured out yet.
Yeah, it makes sense.
One other thing I'm looking at here, because we talked about debt and multifamily, early on, I'm talking to a sponsor and he's trying to spin up a fund where they go buy distressed multifamily notes, which really piqued my interest because I'm more on the kind of moving more towards the debt side. I love multifamily, but he's a former multifamily operator, but now kind of getting the older, phase of his investing career. And he wants to start buying in non-performing multifamily notes to either get them performing or take them over and then reposition them. And I really like that strategy because, hey, if you're, he was showing some deals where they're buying at like potentially 70 cents on the dollar for what the current debt holder has. So just potentially like massive discounts. Now, no traction on that yet, but that is an investing thesis that really caught my eye.
Yeah, I'd like to jump back to the multifamily just real quick because just wanted to say one of the things I'm seeing is a lot of operators now that you haven't seen in a while are coming back and showing some multifamily deals. And I think the next few years, it's going to be really important to continue to as a community, kind of help vet some of these operators, because you really have to make sure that they're clear about their track record. Because some of these operators that are presenting new deals, they have had deals that have gone south and haven't done well. And I'm not saying that they're not advertising their bad deals, but you want to make sure when you're looking at track record and all of that they are being truthful and honest and showing not only their great deals, but also the ones that they struggled with. And so as an LP, we need to be asking those questions. Hey, did you have any struggling deals, and tell me about them? And then also going to the community and saying, hey, ABC operator is sending me this deal. They say they sailed through the difficulties with no problem. Has anybody seen any of their deals that weren't that great? So I think this is really important because now, people have been quiet for 2 or 3 years, no new deals. Well, now they're coming back. You got to make sure that these operators are being upfront and honest. I'm okay if they've had capital calls and challenging deals because it was a challenging time. But if I see them not being forthright or transparent about any of that, that's an easy one, right? That's just I'm done with you pretty much forever. But if you're okay and transparent and saying, hey, here's all the stuff that happened, then okay, I'll look at your next deal. I'll be super cautious, but I'll look at it as long as you're being honest and transparent. So I think as a community, we need to help each other hold the GPs accountable for sharing their true track record.
100%. And in about 3 minutes, we'll actually review a deal. But before we do that, Jim, we are starting to do a PassivePockets membership tooltip of the month. Jim, what's the tooltip of the month that comes with a benefit of being a PP member?
We have this deal analyzer, and it's really great. It's optimized for multifamily, but at some point, hopefully, we're going to get some other asset classes in there. But basically, you take the pro forma information that the operator sends you, and you throw it into an Excel spreadsheet, right? And then it calculates a lot of ratios and a lot of different things for you. And for me, the way I use it, it doesn't tell you, hey, this is a great deal or this is a bad deal. What it does is it shows you some potential red flags, because as you enter stuff in, the cells in Excel, they either turn green for it's in the normal range or they turn red for it's outside of the normal range. And outside of the normal range is not necessarily bad, but the way I use it is I throw the data in there, and anything that turns into a red flag, that's just an opportunity for me to ask the operator some questions, right? Why are your operating expenses outside of the norm for this asset class? Why is your exit cap rate lower or higher than it should be based on the metrics that we have in there currently? And so I use it as a tool to generate questions to ask the operator. Another benefit of it is after you've done 5, 10, or 15 deals through this deal analyzer, you start to recognize which metrics are most important to you, because those are the ones you're focusing on. And so what it enables you to do eventually is you can get to the point where you see a multifamily deal and you can look at your 2 or 3 or 4 metrics, and without even using the deal analyzer, you can look at those numbers and say, hey, these are out of the normal range. I'm either going to say absolutely not, or I'm going to ask my questions immediately, and then you throw it in the deal analyzer anyway. But it gives you reps, right? It allows you to practice and really see how the metrics look. And Paul, you've talked about this before. You can make your spreadsheet look like anything you want if you're an operator. So this doesn't double check and say, yes, the operator is on the up and up. This just allows you to ask some questions and really dig into the deal, where especially for beginners, you might not even know what to ask. Okay, they said, rent increases are 2%. Is that good? Is that bad? I don't know. I mean, it's obviously market dependent and other things, but this kind of gives you some norms to follow. So I think it's a great tool, and I think it's probably underutilized right now, but it is one of the tools you get as a PassivePockets member.
I would echo the benefit of what Jim is saying. I know there's been a couple iterations of the deal analyzer tool, but I remember using it probably 3-4 years ago and was introduced to IRR partitioning, who I think Steve Sue initially brought to light.
He's the godfather of IRR partitioning.
Yes, the left field investors. And I thought that was a great way to kind of break down the deal. And what that IRR partitioning metric is essentially it measures, if you look at 100% of the total returns you anticipate getting on the pro forma over the whole period. It breaks it down from a percentage standpoint of amount received from cash flow and operations versus profitability, sale, exit. So the latter is really much less known, right? The cash flow, although, there can be variations in it, it's a little bit more predictable than what you might get as an offer price in, say, 5 or 7 years from now. So the more the IRR is derived from the cash flow from operations, the more conservative of a deal it is. And I just thought that was brilliant. I'd heard it before, but I never really implemented it into my underwriting. And now it's something I use on every single deal because of this deal analyzer tool. So definitely encourage and echo Jim's sentiments to get on and check that tool out.
Yeah. So if you're a current PassivePockets member, download it. If you're not, go to PassivePockets.com. You're going to do a 7-day free trial and plug in to get that tool, plus a lot of the other benefits with the membership as well. All right, moving to our third agenda item, gentlemen, is I want to do a deal review. And this is actually a real deal I reviewed for a friend of mine. So there's usually two ways people source deals: from directories and platforms like PassivePockets, right? And a lot of times those are bigger sponsors, more established sponsors, because, hey, they're putting marketing budget behind getting their word out there. They know they're going to get, vetted or praised or roasted by the community when they bring their deal out. And so, I think there's usually like a higher bar from my experience. Again, not investing advice, but just observations. The second is through networking, right? Hey, you might meet people at a local RIA or BPCon or PassivePockets Summit, wherever, but a lot of times it comes through friends and family. And so to tee up this story, this is actually a friend of mine. Both our daughters were in kindergarten together, and we were doing kid pickup a few weeks ago. And he was saying, hey, I'm really excited about this real estate deal. My brother has invested in one of the deals before, and he sent it to me. And, this is from the town they grew up in. They both know the operator, and he was super excited about like the deal and looking at it. And he's a high earning, smart, tech W-2 person, and always wanting in real estate, looked again the short-term rentals years ago, but didn't pull the trigger. And so he has that itch for getting into real estate for alternative, exposure to the stock market. But he said, I have no idea. This is the first time I've looked at. I know you do this stuff. Can you look at it for me and just tell me, give me your thoughts on there? I was like, hell yeah, dude. I love looking at this stuff. So I wanted to highlight this because I think there's some good learning points on here. And also it highlights the excited emotional bias a lot of times we get from our network, right? Especially I think when we have less experience, the more excited we get about so-and-so sent me this deal. At least that was for me, right? Oh my gosh, someone sent me a deal. This is the greatest thing since sliced bread. So I think it's a common thing people go through.
When it comes from a friend, right, where your friend is the operator, or, I have a doctor friend, and they get pitched a lot of deals, and some of them are from, doctors who have a connection to an operator, and they don't have all the tools that we have because we're members of PassivePockets, right? These are people that are new to real estate, and they're introduced by a trusted friend. And it doesn't mean these deals are bad or structured wrong, but these people often don't have any way to analyze it, right? And that's why I think this is a really great example. Again, everything I say is join a community, right? I'm always going to be like that because I think it makes a huge deal and is a big help. But this is part of it, right? You find a deal and you're super excited about it. You got to find someone to help you look at it if you're not familiar with this kind of investing.
So we're not going to do a full deal review on here. I'm sharing the screen now for those watching on YouTube. You can see it. Otherwise, we're going to verbal the high points on here. And I redacted personal information and deleted all the sponsor background slides, because a lot of times we talk about sponsor DD. But I really wanted to highlight on here is just kind of like the fee structure, the GP-LP alignment, and also looking at how the debt is structured, because those are some nuances where, it just takes a lot of reps to actually learn how it is. So project overview, this is a multifamily to hotel conversion. Now the sponsor, this is not their first rodeo. They're doing it in a college town in the Midwest, and they've done this before. So that's the kind of the high level business plan. But I want to jump down to just looking at the investment summary. So I'm going to read this to you guys, and then Paul, I'm going to get your reaction first on here. After they, do the heavy construction, they open the hotel, they're going to do a 8% preferred return at a 50-50 GP-LP split. Now, here is the annual cash flow distributions waterfall. So this is how they distribute the profit from the deal. So you get the 8% preferred return paid to you as the LP. Then anything above the 8% preferred return, 50% goes to the LP, 50% goes to the GP. So I'm going to pause there. What are your thoughts on that, Paul?
I think it's an aggressive split for one. 50-50 is a little aggressive. Let's just leave it at that. I mean, a lot of times we see 70-30, 80-20. I've seen 20-80. So, I mean, I've seen it all, but, that's not something that I would get too excited about. And then, it depends on the deal, but in the institutional world, you're typically getting your capital back, then you're getting a preferred return, and then the GP starts to make their share. And that's not always what we see in middle market syndications. And I don't think there's necessarily a reason to avoid the deal per se, that you're not getting all your capital back before the GP starts earning returns. But with the 50-50 split layered in on top of that, I think it's concerning to me. And then I'm sure you'll go through more of this, but I had a chance to review this a little bit before our recording today, and just the fee structure in general, building off of that alignment is really unfavorable, I think, for the LPs.
I'd like to push back just a bit on the 50-50 split. It is not normal for a multifamily deal. I have seen motel to apartment conversions. I have not seen the reverse, where they're taking multifamily and converting it to a hotel. So I don't know if that's standard. I don't know if they are getting more because it's a bigger project. So I think I agree with you. 50-50 split doesn't seem normal. I would like to have more for the LPs, but because it's an asset class I'm not familiar with, perhaps it's more standard on that asset class. I don't know. And I think, Chris, you're going to talk about the waterfall. I'm just talking about the 50-50 split.
Yeah, and those are two different things to look at. So we're, as Paul and Jim highlighted, those are two different things that we're talking about together. Now, here's what's interesting. They have that annual cash flow waterfall, 8% preferred return, and then 50 LP, 50% to the GP. And then it appears a different waterfall for the proceeds from the sale or cash out refi. And this is often, a big chunk of the return. And this is, I'm going to read the 8% waterfall for the cash out refi or sale. Any accrued 8% annual preferred return not paid in prior years. That's normal. Return of equity to cash investors. Then payment of a 1% disposition fee. Payment of deferred development fee, and then pro rata to all owners based on project ownership. So, Jim, anything stand out to you from here? Any comments you have on that waterfall or things you want to highlight for our listeners?
I don't know what the deferred development fee is. I didn't have a chance to look at this before the recording, unfortunately. So I would ask questions about that. Also, that the pro rata to all owners based on project ownership. Typically, I think, Paul, you mentioned this, is that LPs get fully paid out a lot of times before the GPs jump in. And this might be that everyone's paid out at the same time. I'm not really sure. So I would have some questions on those two parts. And then also, I guess I really haven't seen the disposition fee paid as part of the waterfall. That seems strange to me also. I thought all fees were paid ahead of the waterfall typically. So that might be in favor of the LPs, actually, that part of it.
And we'll get to the deferred development fee in a slide or two. Paul, you got any comments on here?
No, I see that the IRR is 14.9 for a 6-year hold and then 15.1 for a 11-year hold. And that to me seems odd because time value of money, the shorter the hold period, the IRR usually goes up because you get your capital back quicker. And that's a good thing as an LP. In this case, there's very little incentive to stick around from year 6 to year 11, the way it's calculated. I can't imagine that calculation is right. I would think that year 11 exit would have a lower IRR. They must be getting significantly more cash flow during that period, but it just doesn't seem to line up to me. So I'd have some questions about that as well.
One comment I want to make on here, in addition to your guys' is great comments, is I don't understand the waterfall on here on the proceeds because the last one says pro rata to all owners based on project ownership. I guess that's in lieu of the 50-50 waterfall, and maybe the 50-50 waterfall is just for the distributions. Yeah, it took me like the third read. I was like, oh, it appears there's two very different waterfalls and, waterfall splits. So a lot of interesting stuff going on here in this deal. Moving on. So here's two other things that jumped out to me. Distributions scheduled to be paid out annually in December. So this is this is saying, hey, once they do the heavy construction, they get the hotel up and running, and then they start paying out distributions. They're doing an annual payout for the annual cash flow distributions. Paul, what are your thoughts on that?
I guess. I mean, okay, kind of non-traditional again. So I'm not sure what the justification is, but that'd be a question I would ask. Why not smooth it out a little bit, pay quarterly? Why in December? And what happens if they miss it in December? Does it get made up in January or February, or do you have to wait till the next year to get made whole? So I'm not sure about that. And then you have highlighted here a 4% management fee and a 20% incentive management fee. What do you know what that 20% incentive management fee is?
I don't. I didn't do like a deep dive into the spreadsheet on here, but I highlight because I was like, that's not the industry norm, and that's for the property management fee. That's not the AUM. So this is a 4% PM fee. And they have in-house PM or sister company, same ownership, and then a 20% incentive management fee, which I have not seen that before. And this is on top of a 2% AUM fee as well.
Very fee heavy for sure.
I would ask about the disposition fee here. It says it's paid at sale, where before I thought that was included in the waterfall. So that's a little weird. The developer's investing $200,000 of equity at a minimum. I forget what the number of the deal is, but it seems like that those fees could probably cover their contribution. So I'm not sure I like that. But, as far as distribution scheduled to be paid annually, I don't know that I have a problem with that. Western Wealth Capital, when they were really humming, they used to pay distributions annually. And that was because they were Canadian is the reason they said they had to do it that way. And I didn't have a problem with that when they kind of imploded and stopped paying distributions, and it didn't really matter that it was annual. There's plenty of things in this deal that are more egregious than just paying annually instead of quarterly, in my mind.
We're highlighting just kind of a few things that really stuck out to me when I did my pass. I just kind of highlighted and shared my notes that I shared with my friend, with Jim and Paul and the podcast listeners here. There's a lot more, but these are things that really jumped out to me, and I think it's really good stuff for LPs are understanding the nuances. And because, hey, when I started reading this stuff, I didn't understand all the fees, all the waterfalls, GP, LP alignment. So we wanted to really highlight this stuff to give you guys just more education.
One more thing, Chris, before we jump into that, I think part of this is when you're dealing with an operator who's coming to you personally because they're a friend, they might be just a friends and family operator, right? Where they have packed all these things that aren't industry standard in there. And, the deals are done and you get your money back and everything's great and you earn some money. But once you start broadening out and these operators then go to, masses of people, they need to fine tune and kind of get their things to industry standards. So some of this is just not standard for the industry, right? The little weird things they have in here. It doesn't necessarily always mean it's bad, although some of these I think we're going to look at and say not great for the LP. That's
a great point, Jim, and it's experience that I've had as well. A group of people that I know had raised like $10 million in a week, like 3-4 months ago, for a fund that had a very sort of broad investment appetite. It was a one-pager. It really didn't explain the investment very well. They came to me and they said, what do you think? Do you want to invest? And I said, well, I need more information because I'm used to seeing these professional decks and just having things really buttoned up so it's deliverable to an LP and they can kind of make their decisions based on everything that's right there in front of them. They may have some follow-up questions, but most of those questions have been answered. This was sort of like, the response that I got was like, hey, do you believe in the team? You know me, I know him. This is a good guy. He's got the credibility and the track record. And I actually believe that he did, but it was just not polished enough and it wasn't enough of what I was used to seeing. So that could be, to your point, Jim, what we're looking at right here. But I think that there's some key things that have been left out of this presentation that I would want to know about, like what's the average daily rate in the market, for a hotel, what justifies the pro forma numbers and what they expect to get for rents. Usually we're seeing that hotels, motels are getting converted to multifamily. Why is this going the other direction? If we hit a recession, what type of headwinds would this type of business plan face? Because it's hospitality. It seems like hospitality is the most affected of all asset classes when we do have a recession. There's considerable questions here that I would have, but it could just be that, hey, they went out to some friends and family, and it sounds like that's what your contact was, Chris, a friend of this group, and maybe that's who they're going off of. But if they are raising money from friends, it begs the question, why are they charging such an unfavorable waterfall fee structure? Why aren't they trying to help these people out?
It gets even more interesting. So I typed up all these notes. I sent to my friend an email. I was like, hey, here are my thoughts. And I didn't say yay or nay. I said, here are my questions and thoughts. And I said, feel free to forward on to the GP. And if they respond, I would love to have the email forwarded back to me. I don't think it ever got a response. All right, so you talked about development fee. So this was a really interesting thing I noticed here in the slide deck. And so they need about 3.4 million equity, 3.4 million in LP equity. I'm on the sources and uses page. So this is where, hey, where the money's coming from. And they're showing that 3.4 million makes up 73% of the equity stack. And then they're showing this developer deferred equity fee of $1.25 million as making up the other 27% of the equity into the deal. I'm going to pause here and then I'm going to jump down somewhere else because this is where I spent some time going back and forth to different page. This is one of their pro forma pages. Yeah, on this page, they're showing 25% equity of 3.4 million, which goes to that, 75% loan to cost value, right? That's what's showing up, I believe, on the term sheet from the bank is 3.4 million, so 75% loan to cost. And then coming back up here to the summary page, up here they're showing this deferred fee equity of 1.25 million as essentially taking about a quarter of the equity. So the way I read this is phantom equity. This is not real capital that the developer is putting into it. And they said somewhere else in there, hey, rather than us taking, I think, the 2%, developer fee or 2 or 3% development fee, which is, pretty standard, they're going to defer it and then roll into equity. So very odd structure to me. And it also made me wonder, well, if they're not taking their development fee, how are they keeping the lights on? So I think it puts the project at risk. And then also, I think it creates a higher LTV on the project to where the investor takes more risk, but developers get more upside, essentially. So I'll pause there, let you guys make any comments or clarify anything, because this is a very nuanced item here.
It's a 10% development fee then, right? I mean, it's 1.25 million. The project cost, they say, is 14 million, but the bank says it's roughly 13 million, which means the deferred equity fee is not included in the information sent to the bank. It's actually that 1.25 million is an extra cost on the project. It is not equity, and it's not 2%, right? 2% of 13 million is not 1.2 million. It's closer to 10%. So I don't even know what to ask there. Like, how does that even work? That doesn't make any sense to me, where you're saying it's a 2% fee and I'm doing some math and it looks like 10% to me. I don't know, Paul, is my math wrong?
No, I mean, I think I would need to look at this more carefully to speak really educated on it, but it does beg a few questions. What is the actual loan to cost here? And how much is the developer earning and when? And how does that align with LP's interest? But I think, we've talked about it in past recordings, dig in and delete or whatever. We were looking for kind of a quick no. And this is where it's like, if I can't figure this out in a timely fashion, I've got other things to deal with. So I'd probably be a quick pass because of these reasons.
Yeah, for sure. This is a no, right? Just because there's, if unless I know the operator and they're a friend of mine like that other guy, then maybe I'd dig in. But yeah, this is a delete pretty easy for me.
I agree. And that was really the point of, I think, doing this exercise is, hey, here are some high level things that, we look at and a lot of other, LPs look at and aspiring LPs can look at as well. Like, hey, how do you do that first pass? And if it's very fee heavy or it's a poor waterfall, it's just like, there's some inconsistencies in here and pretty major inconsistencies. A lot of times that's okay. I spent 15 minutes. It's just, delete and move on, right?
But you wouldn't know that. You wouldn't know unless you have some experience, right? So if you're getting this from a buddy and you're not lucky enough to have another friend like Chris who can look at it for you. And again, I know I sound like a broken record, community, right? Have a community. But if you don't have someone kind of helping you look through this, you might think that a 1.25 million deferred fee for the developer is normal. And that's 27% of the equity in the deal when it's, as Paul said, I think, or one of you said, it's phantom equity. You wouldn't know any of that if you're just looking at this like, okay, this is my first deal, or maybe this is the only operator you deal with, right? Because a lot of LPs get into this with somebody they know that keeps sending them deals, and maybe they keep investing in those deals. And there's probably returns, right? At the end of this, the deals you said they've had some successful exits, so it's fine, but it's not standard, and you're not earning as much money on this deal as you could if you were, looking at some of these things and understanding this better.
I wasn't planning on bringing this up, but Paul, you had mentioned what are their comps, what are they bringing? They do have a sensitivity analysis on here. I won't show because I didn't redact or I didn't add that page in this version, but they had in year one of stabilization higher than market average occupancy rates, which is extremely bullish, right? Hey, I think they were estimating like 75%, and based on their, industry, it was like a 68% market wide. Beating the average in year one is incredibly difficult to do, aside from like year 2 or 3, once you kind of gotten the muscles worked out. And the interesting thing was when you actually drop the occupancy down the market rate, the cash flow about collapsed on this property. It's like a low single digit. So talking of sensitivity analysis and comps, like it was like, well, hey, not only is this, hey, fee heavy, but this is, hey, if everything goes really well, we need it. But if we're off slightly on some of these expectations, the cash flow just goes sideways.
For a conservative investor, that's always been kind of like the biggest challenge for me when it comes to hospitality. I haven't looked at a whole lot of hotel deals, but I have looked extensively at short-term rentals for probably 5 years and never pulled the trigger because I could never get comfortable with what the occupancy was in the market. And it varies year by year. It's all over the map. So it makes it very difficult to put together a pro forma that you can feel confident in. You have to have a lot more in reserves. You have to have, downside protection. And it's just more difficult to do than in long-term rentals, single family, multifamily, triple net, etc.
So to wrap up here were kind of 2 comments I said to my friend, and I'll kind of reiterate here for the podcast listeners is 2 of my takeaways are great sponsors structure deals that work when things still go sideways. Hey, we're off on here, we're over budget. The cash flow does not collapse. This sponsor structure deals for when everything goes, I don't like to say perfect, but very close to perfect. I think we all know, hey, you hope for the best, but plan for the worst type saying. The second thing is what I told him is I don't feel like this is a fair partnership structure. I would label it more as a fee extraction machine dressed up as a deal. So I think it's incredibly favorable to the developer and amazing terms for him. But I think it's not favorable to the LP and also puts the LP into just a lot of high risk possibilities. You guys got any closing thoughts or kind of like macro takeaways for our listeners?
I think that last point really hits home is you want it to be fair for both parties, right? I want the GP or the developer to make money. I want them to make really good money on these deals because that's how they keep the deals going. That's how they can do another one. I want to make sure that they are paid well up front so they don't have to worry about, covering expenses and things like that. But as you said, Chris, it needs to be fair. It needs to be equitable between the LPs and the GPs. And this one just isn't. I also would not invest in a deal that was way too beneficial for the LPs because I'm not sure that that deal would be able to come to fruition because the GP needs money. So it just has to be fair. We're not sitting here picking on the GP because they're paying themselves too much. It's just that they're paying the LPs too little, right? It needs to be a fair share. That's all.
Well said.
Yep, totally agree with Jim on LP-GP alignment. I'll take a different angle on your feedback question, Chris, and just focus on getting reps as an LP. I mentioned that you want to be in a position where you can kind of pass on deals relatively quickly when you see stuff that, makes your hair raise up a little bit or just, you lose interest in it. You want to be able to make a no happen relatively quickly because we all have time constraints. We're all busy, but you don't get to that point unless you look at deal after deal after deal. So if you're a newer LP, these are the type of deals you kind of want to see so you can just evaluate them and see where there are potholes and landmines, et cetera, so the next time to look out for these types of things and when to say no.
And, for people that deals out there, I know myself and Paul and Jim all going to email. I imagine we'll probably get emailed more after doing this deal review. We can't do individual deal reviews for everyone in the community. I mean, this guy's my buddy, so he's taking me out to a nice steak dinner eventually as a thank you. This is where the PassivePockets community comes into play. Go on there and see what other members are DDing on deals, or if you have a deal, go share it in there and do that group due diligence because there's power in numbers and there's also a lot of investors that are much smarter than the 3 of us on this call, and hopefully you can kind of get their feedback as well.
And I'd like to add to that, Chris, when you do that in the forum, a lot of times I see people that just post all the details of their deal, but they do not post any of their own opinions on it. And it's asking a lot for the community members to then not only click on your links and go and do a full deal analysis, right? This could take 30 minutes to 3 hours for people to do. So when you do it, summarize the deal, the key points, and then ask your questions. Like, here are my concerns. Here's what I'm looking at. And then it makes it much easier for everybody else to chime in. Don't expect them to underwrite the deal for you. Expect them to comment on your take. And if you're not sure because you're new, then just say, hey, here's some things I'm looking at because I read Brian Burke's book and, but I'm really not sure. It's okay not to know, but to just post it and expect everybody in the community to analyze the deal for you is not realistic. So help everybody out by summarizing the deal and giving a little bit of your own opinion in there as well.
That's a great point. I'll add on there. When I see people post like that, whether it's when I was doing active deals on the BP forum or passive deals on the passive, if you don't put your own analysis in there, I don't even bother replying. If you put your own thoughts and commentary in there, I have a much higher probability of replying them because I like people that put effort into things. So I'm really going to harp on that point. Well, guys, another great session. Thank you so much.
Thank you, guys. Good chatting.
Thank you, Chris. This was fun. Enjoyed it.
All right. Well, that's a wrap for this month's Passive Pockets Pulse Check.
If you want more underwriting reps and the tools we mentioned, join the conversations inside Passive Pockets. You can download the deal analyzer, see LP reviews, and see how other LPs are stress testing deal structure, debt, and fees. Check it out at PassivePockets.com for a 7-day free trial.
Thanks for listening to the October Passive Pulse Check. Be sure to follow the show, share it with an investor friend, and we'll see you next month.